Welcome to the Deep Dive. Today our mission is to really get under the hood of GE Healthcare Technologies, Inc., ticker GEHC. Now, this is a medical tech giant, 125 years old, currently trading around $75.51. But here's the kicker, the real puzzle. Expert valuation models are all over the place. We're seeing estimates from like $68 a share on the low end, all the way up to a super bullish $123.
Yeah.
It's a $55 difference. So we really need to dig into the sources today and figure out why there's such a massive split.
It's a fascinating situation, isn't it? That huge swing really comes down to how you weigh, the company's solid recurring business, its moat against some pretty serious headwinds. Think geopolitical risks, that recent growth slowdown. We're looking at GEHC as of October 5th, 2025. And yeah, we'll break it all down across 7 chapters: business, management, financials, market view, ownership, risk, and then wrap it up.
Okay, sounds like a plan. Let's jump right in. All right, Chapter 1, business analysis. Let's start with the sheer scale here. 53,000 employees operating in over 100 countries, touching, what, 1 billion patients a year. It's huge. So how is this whole thing structured? What's the actual business model keeping this giant running?
Well, it's built for stability, fundamentally. It's a hybrid model. So in 2024, they pulled in about $19.7 billion in revenue. Now, roughly 2/3 of that comes from product sales. Think of the big machines, CT scanners, MRI machines, those advanced ultrasound systems. That's the upfront sale. But the really interesting part, maybe the defensive part, is the other third. That comes from their high-margin service contracts and other recurring revenue streams.
Okay, that recurring revenue, that sounds like where the moat is,
Yeah.
about half their total revenue, you said?
Yeah, roughly 50% is recurring. That includes service contracts, naturally, but also digital subscriptions on their Edison platform. And something really key, pharmaceutical diagnostics, or PDX.
PDX, those are the contrast agents used in the scans, right? The
Yeah.
consumables.
Exactly. If the scanner is the printer, the PDX contrast agent is the essential ink. It's often proprietary, so hospitals using GEHC machines have to keep buying their ink.
Ah, the classic razor blade model. Keeps customers locked in for a long time.
Precisely. It creates very high switching costs and a predictable income stream for potentially decades, the life of the machine.
And their market position must reinforce that. It's basically an oligopoly, isn't it? Them,
Yeah.
Siemens, Healthineers, Philips.
That's right. They're neck and neck with Siemens in the huge CT market, both around 37% share. Strong number 2 in MRI, again around 37%. But where they really dominate is ultrasound. They're the clear global leader there, holding somewhere between 31% and maybe even 40% of the market. And all this is built on this enormous installed base globally, over 5 million pieces of medical equipment out there.
Let's touch on the tech edge, specifically AI, because this seems crucial for that higher valuation case. Sources say GEHC is way ahead, with 58 FDA authorizations for AI or machine learning-enabled devices. That's the most in the industry.
It is, yeah. And that's a huge part of their strategy. They're not just selling new boxes, they're layering these high-margin, AI-driven software capabilities onto those millions of machines already out there in hospitals. It improves efficiency, clinical outcomes, basically makes the existing hardware much more valuable without forcing hospitals into massive new capital spending. That's the pitch.
Okay, Chapter 2, management evaluation. We've got the scale, the moat,
Yeah.
but a ship this big needs a good captain. Let's talk CEO Peter Arduini. What's his story? What does his track record suggest?
Arduini is seen as a really solid operator. He steered the ship through the complex spin-off from GE, which was no small feat. And his time before GEHC at Integra Life Sciences is quite telling. He managed to quintuple the market value there. Plus, and this is important in medtech, he successfully handled some major FDA compliance issues back in 2013 and 2015, so he knows how to navigate tricky regulatory waters.
Right, experience counts there. And his capital allocation strategy now, it seems very focused, maybe even a bit conservative. Lots of R&D focused, targeted acquisitions.
Definitely focused. R&D spending is up about $1.3 billion in 2024, which is 6.6% of revenue. That's climbed from around 5% back in 2022. And the M&A is what they call bolt-on. They're buying smaller, specialized AI companies like MIM Software, Icometrix, Caption Health. The goal isn't empire building. It's acquiring specific tech AI capabilities that they can quickly plug into that huge installed base using their existing sales channels. Very strategic.
Let's talk capital efficiency. I saw a number that jumped out at me. Return on invested capital, ROIC, at 8.2%. How significant is that figure?
Oh, it's very significant. ROIC tells you how well management is using the money invested in the business to actually generate profits. An 8.2% ROIC might not sound huge in absolute terms, but compare it to the medical device industry average, which is only about 2.1%.
Wow, nearly 4 times the average.
Exactly. That number is strong quantitative evidence that the business has a durable competitive advantage, that moat we talked about, and that management is deploying capital effectively.
And in terms of returning capital to shareholders, sounds like they're playing it safe for now. Low dividend, very low dividend payout. Yeah, under 5%. And they've prioritized paying down debt about $1 billion in 2023 rather than big share buybacks.
Makes sense for a newly independent company. Build up the balance sheet first.
Right. It signals prudence, focus on strengthening the foundation and funding that R&D and M&A strategy before getting aggressive with shareholder returns.
Okay, Chapter 3, financial analysis. Now, this is where we hit the speed bump, right? The core argument for that lower $68 valuation seems to be rooted here. Revenue growth has, well, it basically stopped.
It's been a really sharp slowdown, yeah. If you look at the compound annual growth rate from 2019 to 2024, it was, okay at 3.4%. But 2024 itself, just 0.6% growth. That's a huge drop from the 6.6% they saw in 2023.
Ouch. And the reason?
Management points directly to market softness in China. China is a really important market for their big-ticket items, the high-margin equipment. So a slowdown there really hurts the top line.
So the growth story hit a wall, but is the underlying business still solid? I mean, are margins holding up? Is cash flow okay? Yes, the underlying stability is still there, which is kind of the counter-argument. The gross margin is holding steady around 41.7%. Operating margin is decent at 13.3%. And importantly, thanks to all that recurring revenue we discussed, they're still generating substantial free cash flow, about $1.6 billion in 2024. So the business is resilient. It's not falling apart. Financially, they look healthy too. Debt to equity is moderate at 1.03. Current ratio is fine at 1.17. They can cover their short-term bills.
But that stability clearly hasn't been enough to convince the market entirely. With the valuation, a trailing PE ratio of just 15.7. That feels pretty low compared to the broader medical products industry average, 22.1?
Right.
And way below someone like Medtronic, which trades closer to 29.
Right. The market is definitely applying a discount here. They're weighing that 0.6% growth, and as we'll get into, the geopolitical risks pretty heavily. The big question is, does that 15.7 PE represent a bargain opportunity because the headwinds are temporary, or is it a fair price given the current challenges? That's the debate.
All right, moving into part 2. Let's start with Chapter 4, market sentiment. So the stock's at $75.51. What are the Wall Street analysts saying? Are they seeing that PE discount as a buy signal?
They are, generally speaking, but maybe with some caution. The overall consensus leans towards moderate buy or buy. About 3/4 of the analysts covering the stock have one of those ratings. Their average 12-month price target falls somewhere between $86.89 and $92.31. So that implies, a potential upside of maybe 15% to 22% from where it is now.
So analysts expect things to get better. What about the technical picture as of early October 2025? Where does the chart stand?
Technically, it's sitting in a really interesting spot. It's currently trading above its 50-day moving average, which is typically seen as a bullish signal for the short term. But, and this is key, it's right smack dab around its 200-day moving average. That long-term trend line is somewhere between, say, $75.04 and $77.61.
So $75.51 is right on the line, a make or break point.
Kind of, yeah. If it can stay above that 200-day average and push higher, that could signal the start of a longer-term uptrend. If it breaks down below it, that would tend to confirm the more bearish view. It's a critical technical juncture.
And the general media buzz seems to reflect that tension too, right? Positive vibes on the tech, the AI, new products like the Vivid Pioneer ultrasound. But then caution flags raised about the near-term stuff. China, those tariffs we'll talk more about.
Exactly. The long-term story looks good to many, but the immediate path has obstacles.
Okay, Chapter 5, ownership structure. Who actually owns GEHC stock? You mentioned it's heavily institutional.
Very heavily. Somewhere between 83% and 86% is held by large institutions, mutual funds, pension funds, that sort of thing. But what's really interesting is looking at what the big active funds did in the second quarter of 2025. You saw some major divergence. On one side, big value-oriented funds like Dodge & Cox and Harris Associates were adding significantly to their positions. They clearly saw value at these levels. But on the other side, a huge player like Capital Research Global Investors actually cut its stake quite a bit.
So the big money is split. Some are betting on the value recovery, others are reducing exposure. That perfectly mirrors the bull-bear debate.
It really does. It shows even the sophisticated institutional investors don't have a unified view on the near-term outlook.
What about insiders? The management team, the board, are they buying?
Insider ownership is actually quite low, less than 1%. And looking at recent activity, say the 3 months before our analysis date,
Hmm.
well, there was more selling than buying. We saw about 9 sales versus only 1 open market purchase. Now, a lot of insider sales aren't necessarily bearish. They can be for tax reasons, exercising options, plan diversification.
Right, you can't always read too much into sales.
Exactly. But the lack of significant voluntary open market buying by executives might suggest that while they're likely confident long term, they perhaps don't see the stock as deeply, deeply undervalued right at this $75 mark. Maybe just fairly valued given the headwinds.
Let's tackle Chapter 6, Risk Assessment head on. Starting with the internal stuff, the SWOT analysis highlights what are the key weaknesses inherent in the business itself?
Well, a major one is definitely the reliance on cyclical capital equipment sales. Big MRI and CT machines are expensive, and hospital budgets can fluctuate with the economy, which makes that part of the revenue somewhat volatile. Another point often raised is that historically, GEHC's R&D spend as a percentage of sales was a bit lower than rivals like Philips or Siemens.
So you mentioned management is actively increasing that now.
Correct. They seem to be addressing that, pushing R&D up to 6.6% of revenue, but it's something investors watch.
Okay, now the big external threat that really shook things up in 2025. Those U.S. imposed tariffs. What was the initial damage assessment? It sounded pretty bad.
It was. Management initially came out and said they expected a negative impact of around $500 million for the year just from those tariffs. Translating that to earnings, it was estimated to knock about $0.85 off the earnings per share, the EPS. That's a significant hit and definitely fed into those lower valuation models.
A $500 million hit is massive, but then management seemed to pull a rabbit out of a hat. They mitigated a lot of it.
They reacted very quickly and effectively, yeah. It really showcased their operational agility. They went into overdrive restructuring supply chains, finding alternative component sources, dual sourcing, and even shifting some production. The result was impressive. By July 2025, they announced they'd managed to cut that expected $500 million impact almost in half.
Wow.
Yeah. And because they mitigated so much of that cost pressure, they were actually able to raise their adjusted EPS guidance for the year, lifting the midpoint up to $4.53.
So the risk was real, the initial hit was scary, but they proved they could handle it. That's actually quite bullish for management credibility.
It absolutely is. It shows resilience and strong operational control, which is crucial when you're facing unpredictable geopolitical headwinds like tariffs.
All right, Chapter 7. Conclusion. Let's bring it all together. We started with this huge $68.20 to $123 valuation spread. Can you lay out the core arguments for each side one more time? The bull versus the bear case.
Sure. So the bull case really hinges on the quality and durability of the core business. You've got a wide economic moat built on that massive installed base, high switching costs, and almost 50% recurring revenue from services and PDX. Bulls also emphasize the future growth potential from AI leadership, integrating digital health solutions onto that base. And crucially, they see the current valuation at 15.7 PE as a discount for a high-quality company facing temporary issues.
Okay, that's the optimistic view. Now the bear case. Why $68?
The bear case acknowledges the quality but focuses on the constraints and risks. First, the sheer size of GEHC makes high percentage growth difficult, the law of large numbers. Then there are the persistent headwinds. The softness in the crucial China market, which faces intense local competition, and the constant competitive pressure from well-capitalized rivals like Siemens and Philips, who are also investing heavily in AI. Bears essentially argue that the 0.6% growth isn't just a blip, and the path back to strong growth is uncertain and challenging.
And the valuation models reflect this tension perfectly. That discounted cash flow, or DCF analysis, spitting out numbers from $68 to $123. It all comes down to the assumptions you make about future growth, doesn't it?
Exactly right. A DCF model is highly sensitive to the growth rate you plug in for future cash flows. If you plug in low growth reflecting the bear case, you get closer to $68. If you plug in higher growth, assuming they successfully leverage AI and overcome the headwinds like the bulls believe, you get closer to that $123.
And with the stock trading at $75.51, near the bottom of that range.
It suggests the market right now is pricing in more of the bearish scenario. It's weighing the China slowdown and tariff impacts more heavily than the potential long-term AI growth story and the moat's resilience. Looks like a classic value situation if you believe the headwinds are temporary.
Which leads perfectly into our final thought for you, the listener, to chew on.
Yeah, think about this. The stock's sitting right near its long-term 200-day average, and it's valued towards the low end of its intrinsic value estimates. So the core question for anyone looking long-term is, can management successfully execute on this increased R&D spending and integrate these bolt-on acquisitions effectively enough? Can they genuinely shift that growth narrative away from the recent stagnant 0.6% back towards something closer to the broader medtech industry average, maybe 6.5% or 7.0% growth? If they can do that, you unlock that higher valuation. If they can't, the stock might stay range-bound. That's really the crux of the investment thesis right now.
That really crystallizes the challenge and the opportunity. A fascinating deep dive. Thank you for joining us. If you want more deep dives like this one, and remember, we are covering all the S&P 500 stocks over the next few months. Make sure you like and subscribe to the Stock Analytics AI YouTube channel. Members at €4.99 a month get priority access and can request tickers. And hey, if you just want a one-off deep dive on a specific stock, drop us a super thanks. We appreciate the support.
And just a reminder, this analysis was generated by an AI system. It's for educational purposes only and definitely shouldn't be taken as financial advice. Always do your own homework or talk to a qualified financial advisor before making any investment decisions.